Happy Friday, everyone. Happy as optimism was driving the markets yesterday after strong results from TSMC landed on the market. But yesterday's optimism doesn't change the fact that markets are entering a more demanding phase in AI. Last quarter actually warned that impressive numbers can sometimes mask important details, whether it is complex financing structures used to fund AI infrastructure or revenue growth that has yet to translate into cash. So against the backdrop of rising costs, high leverage, and increasingly stretched valuations, investors are becoming less forgiving. Regarding the broader market reaction, with big technology carrying such an outsized weight in most loved equity indices in the US, even small disappointments from the earnings could have big market consequences. Therefore, and despite yesterday's optimism, I would like to take a cautious approach here. This earnings season may prove less about celebrating AI's promises and more about testing how resilient and how sustainable the story really is. So welcome to Swissquote's Daily Market Talk. We are Friday, January 16th. I'm İpek Özkardeşkaya, and everything I will say in this video is based on my own opinion and analysis, and this is not financial advice.
This show is brought to you by Swissquote.
Yesterday was refreshing. Refreshing in the sense that we went back to that optimistic, euphoric feeling of the past 3 years with AI dominating the headlines in a good way, with strong numbers from TSMC and a great reaction from the market. TSMC was actually quite timid in the Asian session I was talking about yesterday, and that was certainly because of the confusion regarding the announcement that Nvidia would pay 25% tariffs if it wants to export its H200 chips to China. There were also uncertainties in the air regarding the trade negotiations between the US and Taiwan, with the US asking for more investment in chip plants from TSMC to bring production to the US, a demand that is not only costly upfront because the company is committing $165 billion to build 6 fabs in the US, but also will be increasing operating costs by 30 to 50% compared to chips if they were produced in Taiwan. But anyway, these worries evaporated when the Western traders stepped in and AI stocks ended up having a good day. TSMC rose more than 4% in New York. ASML jumped 6% to a fresh record high in Amsterdam, and VanEck Semiconductor ETF rose some 2%. That optimism was also topped by the announcement of a trade agreement between the US and Taiwan, bringing the tariff rate to 15%. So the S&P 500 closed the day near a record high, and other indices gained as well. But note that most candlesticks on my daily charts were in the red, meaning that yesterday's trading session was not outright positive from the beginning to the end. The positiveness of the beginning gently faded into the session's close. Investors spent a good part of the day scaling back earlier gains and asking questions. Is the news really that good? As we will be diving into the guts of the earnings season in the coming weeks, many technology reports actually will be examined with great focus on detail. Remember, last earnings season, the big technology companies announced blowout numbers, but for some, the good-looking numbers were somehow wearing makeup. Think of Meta offloading the bulk of its AI data center financing to private credit players like Blue Owl and PIMCO, or Nvidia booking revenues that hasn't yet turned into cash. And also keep in mind that the worries of circular AI deals, over-leveraged investments, and the delayed ROI remain on top of investors' minds as well, topped by the rising electricity and metal costs, rising memory chip prices, and potential supply shocks. Think of China here threatening to restrict its rare earth metal exports in reaction to the tensions in Iran and Venezuela, for example, where it normally buys oil. Well, they are now buying more from Canada, apparently. But anyway, what I'm trying to say here is this earnings season may not be a piece of cake. All of these little details, or elephants in the room, will matter as much as the shiny headline figures. And remember, these AI stocks are obviously valued to perfection, so they can make no mistake. So walking into this earnings season, it feels like the big technology is losing its leverage to impress investors, and that could eventually weigh on market sentiment. And given how big they have become, well, it could really heard. The other day, the S&P 500 was down, for example, when 300 companies in the S&P 500 closed the day in the positive. It was just that the technology stocks were not being happy. So it's going to be interesting to watch. And if that's the case, if the technology earnings can revive further appetite among investors, well, the rotation trade will simply continue probably because the economic backdrop remains quite supportive. The S&P 500's equal weight version, for example, has been playing catch up with the market cap weighted technology heavy version of it, and the US small cap index outperformed the S&P 500 for the 10th consecutive session. That's something we haven't seen for a long time, and the latter is set to continue as long as risk appetite remains in play. And the good news is that that is the case for now. Appetite is supported also by returning Fed liquidity. Look at that mini spike that we see in Federal Reserve's balance sheet there. The Fed is out buying. It is not buying the same stuff that it used to, so long-dated government bonds, but it's buying nonetheless. It's buying short-dated T-bills. And that liquidity must go somewhere. Guess where? So this week, the banks kicked off the earnings season with overall positive results. While the price action didn't necessarily reflect these relatively strong results earlier in the week, as everybody was rather focused on that 10% cap on the credit card interest rates imposed by the White House, Goldman Sachs and Morgan Stanley reversed that selling pressure yesterday with blockbuster numbers when they released their earnings yesterday. No need for numbers, they just posted record revenues simply. So both stocks hit an all-time high level, and these bank stock prices are so high today, and they have been rising so roughly since 2020 that the 2007-2008 subprime dip looks insignificant in the long-term chart. One of the major energy busts for these bank stocks is AI. We've been saying that AI is not a technology story only, and Goldman Sachs CEO highlighted yesterday the tremendous public and private capital fueling AI. Surprised? And Morgan Stanley CFO completed that statement by saying that the need for capital markets and structuring expertise in terms of what's going on within the AI ecosystem is clearly there. Hell yeah! Look at Meta, for example, that structures that to make its balance sheet look like a fresh sheet of paper. The problem is, because there's always a problem, well, there are risks to this capital expansion, obviously. Investors now want to see return, that's one of them, return to their investment before these AI infrastructures becomes outdated. So it is going to be complicated. But zooming out, let's say a quick word on the global macroeconomic news as well. The Philly Fed and Empire manufacturing indices yesterday printed stronger than expected numbers, and the US jobless claims fell last week, suggesting that the Federal Reserve could eventually wait before cutting the interest rate further. The US 2-year yield that best captures these Fed expectations jumped to a 5-week high as a reaction, pushing the US dollar index to the doorstep of the 100 psychological mark. Crude oil also fell sharply yesterday, around 4%, and remains under pressure this morning on presumed the escalation of tensions in Iran, and precious metals also retreated. But that hammer formation on the silver's daily chart warned that investors are out and still seeking to enter at depths to keep this rally running. So I still expect a further rise toward the $100 per ounce level in silver before a more meaningful pullback. Because there is no doubt, yes, that there will be probably a 10 to 20% pullback sometime in the foreseeable future, but we simply don't know when. Good news is, in the medium run, however, there is little doubt that this debasement trade, which weakens the US dollar, will continue to weaken the US dollar, and that will be supporting metal prices. And the last thing for this week, if you're worried that we're facing a commodity-led inflationary cycle, well, the best way to hedge against this risk is to build exposure to these commodities. So I will leave it here for this week. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. And follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And don't forget to watch our yearly market outlooks on this channel as well. And don't forget to hit the like button on these videos to let us know that you enjoy them. We also like to receive a little message if you liked it. So I will leave it here right now, and I will see you again next week. Until then, good day trading and have a lovely weekend.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.